YouTube Live. So this is our chance to spend an hour together and you can ask any question you like. Now, this week, clearly, this month, there's been huge market moves due to what's going on in the United States and the reaction globally to it. Now, it's a kind of interesting, I think, that until maybe just a couple of weeks ago, markets were quite blasé about all of the tariffs and the repercussions, the economic repercussions. Well, suddenly markets do care. And I think it's really when there was a kind of ratcheting up of the scope, but also the size of the tariffs themselves, when Mexico and Canada were included with very high tariffs. I think that's when markets really paid attention. And I think at that point, people realized that, yeah, this is going to have a negative impact on trade, on corporate profits, and the counter tariffs are going to be very severe because, I mean, talking about taking away Canada's sovereignty sounds like a joke, but to Canadians, it's no joke. And I think that's going to be a huge problem in terms of the credibility of the United States now. If they carry on down this line of saying that they're trying to make Canada the 51st state. I mean, that's ridiculous. So I think some of these claims are just nonsense and a lot of it is just bluster. I mean, renaming the Gulf of Mexico to the Gulf of America doesn't affect markets, but tariffs affect markets a lot. What's kind of positive, I guess, in a way, is the European reaction to tariffs. Also to the fact that they're going to have to look after themselves militarily here in Europe. Because what that's created is increased spending on defence. And if you look at stocks in Europe, they've surged over the last 3 weeks or so, 4 weeks, because of the defence sector, but also banks, which were very cheap before this rally. And in fact, while the US has been heading downwards, Europe has been heading the other way. It's been heading upwards. So some people have been joking that instead of MAGA, Make America Great Again, this is Make Europe Great Again, MEGA, which I thought was quite funny. But certainly in terms of the returns that we've seen, that has been quite positive. And certainly some of the PensionCraft community has been buying a basket of European stocks and they shared a pie on Trading 212. So it's interesting to see the community kind of pitching together to do that and help one another. So that's, I guess, one of the benefits of membership. But still, I think that kind of summarizes where we are now. The US is still very expensive, of course, relative to the rest of the world. Still very dominated by those magnificent seven stocks, which are also very expensive. Tesla, unbelievably, still has a 90 times multiple relative to forward earnings. Even though it has fallen a lot, it's still incredibly expensive relative to the other Mag 7 stocks, which is surprising given what's been happening to its sales in Europe, which have basically collapsed due to the behavior of the CEO, Elon Musk. So I think, a huge amount going on right now. Germany's removed its debt brake, and that means that it can spend more to stimulate its economy. That's pushed up German yields, so yields elsewhere have also increased on government bonds. So huge amounts going on there. And in the currency market, what's really interesting is that when we had the big sell-off due to the tariffs, the dollar weakened. It didn't strengthen, and it's seen as a safe haven usually. But this shocking thing is that the US may no longer have unequivocal safe haven status because of the choices of the US administration. So huge changes going on in markets right now and some really interesting changes too. But as always, we have to just kind of guess what's going to happen to markets in the future and just hope that stocks eventually will recover. They have had a bit of a wobble so far, but I don't think it's been much of a sell-off at all. Given where valuations are and how concentrated the market is. So I think we could be in for some interesting times ahead, put it that way. So that's kind of a summary of what's going on in markets. Now, previously, we did a I've just been on holiday with Laura in South Africa. We went to Cape Town for her daughter's wedding, which was amazing. If you haven't been to Cape Town, I definitely recommend a visit. It's just such a beautiful place. Amazing wine, amazing food, beautiful scenery, just a lovely, fascinating culture, which I'd never seen before. I'd never been to South Africa before. I've travelled quite a bit, but never to South Africa. And Cape Town was incredible. But before we went away, someone did a super chat from New Zealand after the YouTube live finished. So I'm going to start off with his question, or her question, I'm not sure. And they said, I'm in New Zealand, so I never get to see your live streams because of the time zone, but I always watch them later, and I really appreciate the info and insights you give. Thank you. And they say, I've got a question that I'd love to get your thoughts on. Any chance you could read this out on an upcoming live stream? Yes. In New Zealand, our mortgage system works similarly to the UK. So you fix your mortgage for a period of your choosing, say 1, 2, 3, 4 or 5 years. And then the rates for those periods are set partly by the market and partly by the bank's funding situation. In other words, how much they've managed to get in savings accounts, term deposits and so on. They also have floating rate options, but those are almost always higher than fixed rates. My theory, they say, is that choosing the shortest term is likely to be the best bet in the long run. Of course, you have the risk that rates go higher and you have to refix at a higher rate, but that's precisely why it should be the best bet. Okay. Basically, you're taking on the term risk instead of offloading that risk onto the bank. And of course, if the bank's going to take on that risk, they'll demand compensation for that risk. So we'll address that too. That's an interesting point. So as long as you're comfortable with the risk and feel like your employment situation is such that you're able to take on the risk, shorter fixed terms will lead to less interest over the life of the loan. Does that sound reasonable to you? Anything I might be missing? I think the thing that people don't realise is the way that banks generally create these fixed rate mortgages. Now think of it from the bank's point of view. They don't want to take a directional risk on rates. They don't want to have the risk that they'll have lent out at a certain rate, then rates will increase. What they want to do is turn that fixed rate debt into floating rate debt, probably, or at least not to take a punt on which way rates are going to go. So what they actually do is use swap rates. So these are interest rate swaps. So this is a huge derivative, is very widely traded amongst institutional investors, investment banks, to lay off their interest rate risk or to speculate on interest rates in an unfunded and leveraged way of their hedge funds. Now, what are swap rates? The difficulty with swap rates, if you haven't got a Bloomberg terminal, is it's really hard to find what the swap rates are. They are close to what you'll get with bank rates, with government bond rates. So what I'm going to do is quickly show you the New Zealand government bond yield curve. So that's what this is. Let me just make that a bit bigger. Yeah, so this is the New Zealand yield curve, and let me look at the graph. That's probably easier. The big dark line here is the current yield as of today, and then you can see the previous yield 6 months ago in red, 12 months ago in dark blue. So 6 months ago, 12 months ago. So notice what's happened to the shape of the curve. It's almost like a living thing. If you look at the 10-year part of the curve, you can see that that's moved up quite significantly. Currently it's around 4.8%. 12 months ago it was 4.7%. So it's moved up by about 0.05 percentage points. The short end is where all the action's been, because what's been happening over the recent period is the central bank, the New Zealand central bank, has been cutting interest rates. So it started off at, 12 months ago is 5.6, and the latest is 3.9. So it's all monetary policy shifts going on at the short end of the curve, which has been driving things recently. So notice how that also drives everything up to about 5 years. The further you are from that policy rate, which is the very short end of the curve, the less you're affected by the shift in that policy rate. So if you're looking at 1 year, that's very closely tracking the policy rate. 2 years less so, and once we get to 5 years, the effect is quite small. But what you're doing when you buy a fixed rate mortgage is essentially feeding off the swap rate curve, off the swap yield curve, which is similar to this government bond yield curve. So really what you're betting, like you say, is that the short-term rates are never going to spike very high. Now, of course, what's happening at the moment is what you say, which is that short-term interest rates are falling because inflation's falling after the huge spike the entire world suffered about 2-3 years ago, when it spiked above 10% in many countries, including New Zealand. So what we're seeing now is a normalization of monetary policy, which is why the short end has moved down. So yeah, I think at the moment, probably, if you go for the short end of the curve, it will be driven by the policy rate, and that is falling. But what you've always got to consider is what would happen to turn that around. What would make the short end of the yield curve spike upwards again? Well, if there's another energy shock, that'll push up energy prices, that'll feed through into the rest of the economy and push up prices in a very widespread way. So that could also push up the short end of the curve. So that's the risk you're taking. If you fix for 1 year, after a year passes, if there's an energy spike or something else which pushes up inflation, another supply shock like we had in 2021, then you run the risk that you're going to have to fix at a much higher rate. But it is the case, like you say also, that usually the yield curve's upward sloping. So if you fix over a short period of time, usually you'll pay a smaller rate. So that's the gamble you're taking. Do you want the certainty of locking in for some period of time, or are you willing to take the risk that if you fix for a year, rates are going to spike higher and you're going to have to fix again at a higher rate? So it's a very hard call. I don't think it's obvious which one to go for, but I think your approach is a reasonable one, because most of the time the short end of the curve is lower than the rest of the curve because of the term premium. So yeah, but there is no right answer, and I can't really predict what it's going to be for New Zealand. But those are the considerations. Is something going to drive up inflation? And if it is, then maybe you want to fix for a bit longer. But of course we can't predict this. The bank can't predict it. Economists can't predict it. So really it's anyone's guess whether it's worthwhile fixing. But most of the time I think you're right. Fixing for a year doesn't have the term premium and probably it's going to be cheaper. All I'd say is, when you're about to fix, just check the shape of the yield curve, think about what is in the offing in a macroeconomic sense, and is it going to push up short-term interest rates? Will the central bank have to hike rates because inflation's increasing? That's the real thought process, and it's a very difficult call to make. But at least I hope that's answered your question. And I think this is more generally applicable to people in the UK, the US, not so much the US because they can fix for a 30-year period, so lucky them. But I think it is more generally interesting for people not just in New Zealand. So thank you for your question, and thank you for the super chat. Okay, back to me. So do subscribe, and yeah, I'd appreciate it if you do a super chat. We'll push your question to the front of the queue, and as has happened for Amir, thank you. So first super chat is from Amir Ketobchi, one of our regular viewers. Nice to see you, Amir. Salam. And he says, hi Ramin, with the new financial year coming, if you were to pile in 20k into an ISA, an individual savings account, would you avoid US funds? Oh, good question. Or is it a good time to buy them, seeing as they're down? Agree with Cape Town, amazing place. Astonishing place, yeah. So what would I do? I mean, at the moment, I feel quite cautious. You know, I'm quite nervous about putting money into equity at all, simply because the US is so concentrated, it's got such high valuations, the economic uncertainty. If you look at an economic uncertainty index or a trade policy index uncertainty index, trade policy uncertainty index, get it right, those uncertainty indices have just gone through the roof. And usually that creates a more difficult trading environment, and usually it weighs on earnings and economic activity, because companies can't plan if there's a huge uncertainty about tariffs, counter tariffs, and so on. And they may put on less orders due to that because of the uncertainty, and that in turn feeds through to their suppliers and to suppliers and so on. So it creates a chilling effect on the economy. So that's what worries me. Are we going to see a downturn in corporate profits as a result of these tariffs, or are they just going to be used as a threat, and then you can continually applying them, taking them away, which itself creates even more uncertainty. But what would I do? Would I avoid the US? I think I might. There are some ex-US funds out there. So let's just pull up our cheapest funds list on PensionCraft, because one of the developed market ones is ex-US, and I always forget the ticker. The ticker is EXUS, but I think it might trade as something else. Let me quickly pull this up and show it to you. So this is a list of the cheapest funds in multiple categories that we keep for our members. So I'll do it for the UK and share. Okay, there we go. So we're going to look at developed market equity, and the one I've just added is ex-US. Oh, it is ex-US, the ticker, and it's the X-Trackers MSCI World ex-USA ETF. So what you can do is chop the world up into three chunks: US, ex-US, emerging markets. So with three funds you can recreate a global index. So if you're recreating a global index, then the US would be 65% of the global market. EM would be about 10%, so that leaves 25% for ex-US. So that would be your kind of, if you don't want to change the US weighting. If you want to dial the US down, then you simply buy less of the US ETF. So you might drop it by 10%. So instead of 65, you've got 55, and then move that weight into EM and developed ex-US. So the fee for this one is pretty low, 0.15. So you can do it pretty simply and quite cheaply. The EM fund would be the expensive one. Funds there tend to be more expensive, but not hugely so. 0.14, this one from Amundi, 0.15, this one from HSBC, and then finally you'd have a US tracker, which are very cheap indeed. You can buy those for about 0.08, I think, or 0.07 management fee. So I think, yeah, I might well do that actually, which is to split it up. I mean, I'm quite loath to give up the simplicity of my core holdings, because having one fund is very simple, and so there is a bit of a step in order to increase the complexity. But if it was a new ISA, yeah, why not? You could. But that's how I do it. 3 funds, ex-US, developed, US, and EM in those ratios that I just said. That's probably how I'd go about it. Matthew Dick is an ex-super chat. Thank you, Matthew, for your super chat. He says, "What do you think of a pie made up of Japanese trading houses?" Interesting choice. Including Tochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. Inspiration, Mr. Buffett, of course. Now, let me just... this is something that we talked about in our weekly market roundup. So let me quickly show that to you, because this is one of the things that, you know, everybody watches what Warren Buffett does, what he says, and we've just had his possibly last statement as the boss of Berkshire Hathaway. So can I find what I'm looking for? Quite possibly not. Settings, maybe. General. Domains, that's it. That's it. Okay. There we go. So again, let me share this with you. So this was our weekly market roundup for which is free, by the way. You can sign up for that. Just go to pensioncraft.com/newsletter, and we don't spam you. It only comes out once a week, and it's quite funny, right? It's supposed to be humorous. So there was some stuff about Trump bump becomes Trump slump. Okay, a lot of wordplay. Tariffied markets. It's high quality analysis, this. But what I love is our kind of, we usually have kind of news bites at the end of it. So we have one big article in depth and then we have news bites. But this time we're snacking at the buffet of investing wisdom. Now, one of the things he was talking about was exactly that, which is these Japanese trading houses. I don't know if we mentioned it. Yeah, here we go. The exception to America. A small but important exception to our US-based focus is our growing investment in Japan. It's been almost 6 years since Berkshire began purchasing shares in 5 Japanese companies that very successfully operate in a manner somewhat similar to Berkshire itself, which is to have one umbrella company which buys entire companies which feed cash into one another and also get fed cash by the insurance business, which is very cash generative, all those premia. The 5 are Itochu, Marubeni, and so on. From the start, we agreed to keep Berkshire's holdings below 10% of each company's shares, but as we approach this limit, the 5 companies agreed to moderately relax the ceiling because there's a constraint on how much of them you can buy. Over time, you'll see that Berkshire's ownership of all 5 increased somewhat. You'll likely see the Berkshire's ownership of all 5 increase somewhat. I expect that Greg, who's going to take over from him, and his eventual successors will be holding this Japanese position for many decades, and that Berkshire will find other ways to work productively with the 5 companies in the future. So, as you can imagine, the shares in those companies surged on the announcement. But would I buy that myself? I'm not convinced that I would. I mean, it's a very unusual structure to have these kind of mega companies as umbrella companies. What you're really assuming is that they can buy good businesses. And, you know, he's not going to be around forever, bless him. So my concern would be that whoever takes over, which is Greg Abel, I think his name is, may not go through with what Buffett has said. You know, maybe he doesn't agree with what Buffett has said. Maybe there's going to be a big restructuring of Berkshire Hathaway after Warren Buffett leaves. Because it is a very unusual corporate structure. I think it's the only one that's structured that way in the United States, certainly to that size. So if there are activist investors that pile in and break up the company, then, you know, who's to say whether they're going to carry on buying these Japanese trading houses, which are in the model of Berkshire Hathaway. So personally, I'd keep away from them because firstly, I don't think I could understand the businesses. I mean, just trying to understand Berkshire Hathaway is a lot easier because there's so much written about it and they're so transparent. Trying to research how those other companies work, what their drivers are, what their profits are, what their moat is, you know, because if you buy single stocks, single funds, which is effectively what these are, then you've really got to understand the business. And I'm not sure I could. So personally, I'd keep well away, because Berkshire themselves might get split up and may not carry on with these investments after Warren's gone. And of course, it'll be a sad day when he does die. I'll be very upset when I hear about that. Love the guy. But a pie made up of the Japanese trading houses, I wouldn't buy it. Because now it's expensive and I'm not convinced it's going to carry on getting more expensive. Next question is from M. Ahmed, a super chat. Thank you very much, Mr. Ahmed. He says, what are your thoughts on CFD, so that's contracts for difference, day swing trading, and those who claim to teach it, typically in their 20s, and claim to make tens or thousands a month? You can probably tell from the fact I'm laughing what I think about it. Look, there's a very clear distinction between investing and gambling. So let's just spell it out. When you invest, you take managed risks, you invest for the long term, and you're very likely to succeed. By which I mean, if you put a large sum of money into the equity market, a global index fund, leave it for 20 years, it's very likely to give you a good return. Not guaranteed, but very likely. If you put a huge amount of money into a day trading strategy, you could very likely lose all of your money. And look, the fact that they've got all of these disclaimers on their website talking about any company which has CFDs is forced by the regulator to say what percentage of companies lose money. So let's just find one. Yeah, this will do. Here we go. So this is IG in the UK, but you'll find this probably for any regulated, European regulated company. So what I'm talking about, of course, is this stuff at the top. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 70% of retail investor accounts lose money when trading spread bets and CFDs with this provider. And if you shop around and look at other CFD providers, you'll see a similar percentage. So instead of having a very high probability of success with a boring long-term index fund, you have the very low probability of a huge payoff, which is gambling. And that's what CFDs are. Now, the people who teach this stuff themselves, I think, are... How do I put this politely? Okay, well, I won't put it politely. I think they're crooks. I think that what they're selling is snake oil. And I think it's very unlikely that you're going to make money with CFDs. And I think, frankly, these people should be locked up. That's what I think. Because they force people to lose money. They pretend that you're going to make a very successful trading strategy. They're going to sell you signals. Whereas the vast majority of people, as you can see from the stats on this website and others, will lose money. And how could you sleep at night knowing that you're forcing people to lose money? Well, maybe not forcing, but teaching them and giving them a feeling they can succeed when they can't. I think that's dreadful. So, you know, there are not many things that make me really angry, but this really does make me angry. And yeah, I just feel very strongly that these people should be locked up and certainly not allowed to advertise their products. So whether it's trading FX, short term, or trading CFDs, it's just unlikely to work. And people should be made aware of that. And even the regulatory warnings, I don't think, go far enough because of the probability of losing money. So, yeah. But look, if people did this, they're very likely to lose money. And but if you are financially educated, you know that you're likely to lose money. So if you are going to play around with it, just do it with tiny quantities of money, because that way, if you do lose everything, it doesn't really matter. So it should be part of your fund portfolio. So look, half time, let's get Teddy, and that should help the anger abate somewhat. He always cheers me up. It's brilliant. If I'm ever depressed and I have to go out for a walk with Ted, it always cheers me up. Always. Because dogs live in the moment, It's all about the treats. Hello, young dog. Would you like a treat? Yes, you would. Good boy. Now, these are not the stinky ones, which have gone now. These are the beef ones, which he loves. Very good. Very good boy. So he was with his dog sitter while we were away in Cape Town, and he had a ball. He's got a friend, a Labrador called Bino. He's his good friend, and Bino lives in Missenden, which is nearby. And so Ted spent some time with Bino, and he probably got up to all sorts of naughty things. Oh, Biltong, mate. Biltong. Downstairs. Laura. Yeah. Listen, it's Laura. It's Laura. Go on. Good boy. Go, go, go. Ooh. No more treats. Down the stairs. Go, go, go. Come on. There we go. Very good. Right, so I'll just cough for a bit. I picked up a cold on the plane on the way over. That was the only drawback of the holiday, the 11-hour flight. Couldn't sleep. But beautiful place. You can see I've got a bit of a tan. I kind of cooked in the African sun. I just didn't realise how strong it was. Anyway, back to your questions, and let's see what we've got. Yeah, so Super Chats, push to the front of the queue. Please do like, subscribe. Oh, I should talk about our podcast. Many happy returns, which is essentially created by my genius co-host, Michael Pugh. And he's the young, beautiful, clever one. And this is the latest episode. The Road to Wealth, 10 financial milestones worth celebrating. And yeah. And the question was, is all debt bad? So that was the dumb question of the week. So really it's all about the milestones you go through in order to achieve financial success, which I thought was kind of interesting. It's a nice evergreen topic. But there are certain things like when you pay off your debts, it is a kind of watershed moment if you do reach that as an investor. Not one I've reached, I've got to say myself, not yet. Anyway, yeah, many happy returns, our podcast. Do have a listen. And back to your questions. Welcome home, Ramin, Laura and Teddy. Thank you, Andy. Festeral, nice to see you again. I hope all is well, he says. They say. What a week. Please could you give your thoughts on whether it's too late to invest in Europe? I was looking at investing a few weeks ago but didn't. Missed the boat. Yeah, like I say, the PensionCraft community, they created their own pie of investment companies which are defence companies in Europe. So companies like Rheinmetall and others. Let me see if I can find the list. So what they did is they looked up an index of European defence companies and then simply created a pie for the funds for the companies which were tradable. So let's just look at some of the holdings. So Airbus 26%, Safran 22%, BAE Systems 14%, Rolls-Royce 13%, Rheinmetall 12%, Thales 6%, MTU Aero Engines 4%, Hensoldt 3%. Those are the ones I can see. So is that going to carry on going up? Well, bear in mind that Germany has just removed its debt brake so that it can stimulate its economy and ramp up its defence spending. So I think, we're probably going to see a fair old rise in earnings. But these companies are now quite expensive. So is it too late? I don't think so. I think there's still a bit of juice in this trade. Because if we do get a rearming Europe in order to counter Russia, then the profits for these companies are going to be good. And I think what worries me about this war in Europe, potentially, if it does happen, is that historically, the US has profited hugely from European wars. So I just hope there aren't people in Washington thinking, oh yes, another new European war would be great for our business. I just hope people don't think that way. But with the current administration, I think maybe they do. Maybe they do want to profit from such an event. But look, what's clearly happening is that European countries are going to spend using their own defence companies and they won't rely so heavily on the United States in terms of military spending. So is there still juice in that trade? I think probably there is. And certainly if you have a basket of US defence companies, then some of them, like Lockheed Martin, are unavoidable. If you want to buy a fighter jet, who are you going to buy it from? The European ones, maybe. Rolls-Royce would benefit. BAE Systems would probably benefit. Airbus, maybe. But I still think that some of the US contractors or some of the US companies are going to benefit from the European spending. But I think these companies that I just read the list out for are the ones which are going to benefit mostly. There's another ETF, which is NATP, which is a European equivalent. So I'll just show you this quickly. So this is the Future of Defence ETF. So again, if you want to look at the holdings of that, you can see 59% of them are US, only 10% in France, 8% in the UK, 7% Israel and other. But Palantir is the largest holding. Rheinmetall, which has done incredibly well recently, that makes up 5%. And if we look at the chart for Rheinmetall, it's just gone almost vertical over the recent period. Since 10th of Feb effectively. It's gone up to 82 euros from €6. So a huge rally for that company. So this is another way you could get exposure. Go for one of these ETFs. But the difficulty, I think, the reason why we created our own pie in PensionCraft was because I think the European defence ETF wasn't available in Europe, weirdly. Did that just disconnect? I think it might have done. That's another way to get the exposure. So, next question. Let's see if we've got any super chats. No? Okay. Atomic Rooster says, cool, caught this live at the beginning, nice one. Alex M, no stomach for the US at present. Okay. Mega funny, all very good. That's Gerard McCann. Nice to see you, Gerard. Leo says, should I sell my global all cap? No. The thing is, you're going to have volatility, right? And so far we haven't had much of a sell-off at all. So let's look at how much the sell-off has been so far, and I think it's very small. So let's pull up Global Index Fund. Share, so you can see what I'm doing. So let's look at a developed one like VHVG. So VHVG is down by what? Something like, doesn't look like much more than about 5%. Yeah, 6.4% so far. But look, if you're still in the accumulation phase, the way you should be thinking is this is the long-term trend. It's going up. Sometimes it'll go down, which means you buy at a discounted price. You don't sell the stuff you've got. Think about the cumulative return you've built up already. The problem if you sell is you've got to time two things correctly, the selling time and then the buying time. And then the buying time has to be at a lower price than the selling time. Now what usually happens is that these falls are quite short-lived. So what usually happens is you get locked out of the market, you sell after the fall, and then you have to buy at a higher price, which is clearly not a good idea. So if you're drip feeding into your global equity fund as you earn, just see these purchases at lower prices as a boon, a positive, buying in a sale. That's the way to reframe it. But selling your existing holdings is a terrible idea. So don't do that, because you won't be able to time it correctly, and you have to choose your buying time, and it's a real problem doing that. If you've ever tried it, it is very difficult. Back to your questions. Which global index excludes USA is worth looking at? I think I shared that. That's Bonkers About Alice. I've yet to find any global ETF in the UK that exclude US. Ex-US does. I have to buy LGGG and add 2 other ETFs, a Europe one and an Asia one. There you go. So now you've learnt something, Gerard. Hopefully that was useful to you. David Connell says, I want to diversify internationally, but do you think there's value in underweighting the US given the CAPE ratio? It's really difficult to call it, because what you've always got to think is, what would be the catalyst for the US to underperform? And it's still the case that US tech companies have huge margins and very rapid profit growth. And that remains the case. What would make that change? Well, some of the stuff which we're seeing, which is if there is a slowdown in demand in the United States, because remember that tariffs will affect everything. If there's a slowing down of the economy, then even companies like Microsoft would be affected, because if companies have less money to spend, they're going to cut back or not renew their licenses or spend as much on cloud computing as they did previously. And that's going to affect everything, everyone, including tech companies. In a certain way, tech companies obviously don't depend on physical stuff, but they do depend on things like energy. That is one of their costs in some cases, certainly for cloud computing. So that could erode their margins. And a lack of demand, of course, is also going to be a problem for them. So a slowdown in the economy will be bad for tech companies. And this is an example where operational leverage will work against companies like Microsoft, for example. So I think that is a risk. But would I go hugely underweight US? Not hugely. I think maybe a 10% lower weight, maybe, although I'd be loath to do that because I'm not sure I could call it. It's very difficult to time these things. It's very difficult to know which regions are going to outperform. Whenever I've tried it in the past, usually it goes wrong. Okay, so you've got to know your own limits. And personally, bitter experience has told me that, Ramin, you can't time these things. Whereas buying a global equity fund has just worked very well. And it's been very simple, very easy, no regrets there. Night Train 123 says, as they say though, investors write off the US at their peril. Yeah, you wouldn't go hugely underweight. You wouldn't cut it to zero. We're just talking about instead of 65%, you'd have 55. And then of course it's not going to make a huge difference to your returns. But you'll feel clever if the US underperforms. And David Connell replies quite reasonably, my sense is to weight my portfolio according to the world index, about a third international and 2/3 US. Well, 2/3 US is market cap weighty anyway, so not much difference. Sell equities now and buy back or hodl. Well, definitely hodl. Hold on for dear life, because if you're investing for the long term, then these blips are just part and parcel of investing. You've just got to get used to it. We've just been in this incredible period where we have 20% plus returns year on year, 2 successive years in the US. And people, I think, are going to have difficulty when we move out of that back to normal, which is when, stocks go up 5% a year and people feel hard done by. Although that's that's closer to the average. 9-10% on equity is what you'd expect in nominal terms, maybe 5 to 6% in real terms, in terms of total return. That's what you should expect. But people just aren't used to that now. They're used to these crazy returns year on year. So I think it'll be difficult. Oh, something's gone badly wrong there. Did that just cut out? Oh dear, we've got connection problems. Sorry about that. So what have we got? We've got some more super chats. Thank you for you. Thank you, Links Naji. Has done a large super chat. Thank you. They say, what are your thoughts on VCT funds? When does it make sense to use them? E.g. a threshold for CGT when it makes sense, And why is there very little content and comparing different funds? Huge fan. I did a whole explainer for our members, which was all about venture capital funds, venture capital trusts, in fact. Now, let me just kind of briefly outline for people who aren't familiar with it what they are. Now, the UK government wants people to fund small cap companies because obviously these are what generates growth in the country. So they want to provide capital for those countries. They want private investors to provide that capital. So what they do is they provide upfront tax relief to investors who provide their capital. So what you get is a 30% upfront income tax relief on investments up to a huge £200,000 a year. So it is a very sizable tax break that you get. Now you have to hold it for 5 years. That's the drawback. So your money's locked up for 5 years, but if you hold it for 5 years, you get capital gains tax exemption on disposal of the shares at the end of the period. Now the dividends are tax-free. So what people usually do is these funds pay a dividend which is usually quite high, maybe 6%, 7%, and that's tax-free. So that's why people buy them. It's not to buy the next Google or Microsoft. It's not to buy the next unicorn. It's just a tax break, right? That's the way it works. So that's why people buy venture capital trusts. How do you choose the manager? Much harder, because firstly, a lot of the managers don't have much track record. It's quite an opaque set of investments because by definition these are small caps in the UK which nobody's heard of. So you completely rely on the manager to be good. You pay them a very high fee, often 2% for many venture capital trusts, plus you pay a fee for the upside, like a hedge fund almost, 2 and 20 fee structure. So I think those are my problems with it. How do you figure out what the good managers are? It's tricky. There are some larger ones out there, but really you have to depend on the prospectus and any kind of information you have on their previous investments. Personally, I'd probably go for venture capital trusts that buy AIM companies because those are the most liquid and those are the ones where you can track the performance day to day because they buy liquid investments which are marked to market daily. Whereas if they buy illiquid investments that aren't traded on stock exchanges, who knows what it's worth? You've really got no idea the value of the fund. All you can see is the dividends being paid to you. So I think that's my difficulty with it, which is the lack of transparency. But how do you choose a manager? Good question. And I think that's the difficulty, knowing which ones to go for. But if you do buy them, the reason why people go for VCTs is because once you've used up your ISA and your SIP allowance, it's the next thing which gives you a big tax break. And you can put up to 200k into it. So, those are the benefits, I think. If you want a high income where you don't have to pay tax on it, and it's cash which you don't need for the next 5 years. So if you've had a big liquidity event, you've sold a company, inherited money, you've used up your ISA and your SIP, then that's when I might consider it. But this is the difficulty for me, finding the good managers, as you say. And there is no kind of foolproof way of doing that. It's just based on track record. Super chat from Gerard. Thank you, Gerard. Gerard McCann. He says, view on Val W and similar ETF if economy is slowing. So let's just have a look at Val W. I've heard a couple of people talking about this fund recently, so it is an interesting one. Here we go. So this is Val W. It's the Spider MSCI World Value ETF. So obviously value has been out of favour for a long time. In fact, if we get the MSCI World Value Index, we can actually look at the stats for it. But if we look at the holdings before we do that, it's all the boring stuff, right? People... So if you had a list of unsexy companies, this is it. Cisco, Qualcomm, Toyota, Applied Materials, AT&T and so on, a couple of banks. And if you look at the sector composition, it's still a core to technology, but there's a fair old slug of financials, consumer discretionary, and the US is much lower in weighting than it would be for a market cap global index. So let's just pull up the index itself, which is one of the great things you can do with MSCI indices. So this is what I'm talking about, the underperformance. The orange line here is MSCI World, so that's developed markets. The blue line is MSCI World Value, so tilting towards the cheaper companies. Now, this is a strategy that outperformed buying value stocks. It was a strategy that outperformed for over a century. And then suddenly, over the last decade or so, you've got this huge underperformance because the only show in town has been growth tech stocks. And growth, of course, is the opposite of value. So that's why I think people have lost faith with value. But this is the kind of environment where value would do better, because a lot of the cheap stuff, a lot of the unsexy stuff, potentially could do quite well. But there's a big but, which is that a lot of these companies will be exposed to trade and tariffs. So that's my worry, which is that there won't be anywhere to hide, and that these value funds as well are going to be affected by tariffs. So a lot of these are quite cyclical companies, which will be affected by companies cutting back on their spending. Toyota, if you buy a car, you have to have lots of disposable income, which in turn happens if you've got lots of employment, good wage growth. And if there is a slowdown in growth, then Toyota is going to suffer. So a lot of these are going to be cyclical. Banks are cyclical. Intel's will be cyclical. So I think that's my worry. Value won't be the place to hide. Maybe quality would be a better choice, because those are companies with strong balance sheets which can weather this storm. But value, I'd be concerned that these are companies which may not be able to weather it as well. So that's my worry. Personally, I probably wouldn't go for value. I'd probably go for quality if you had to choose one factor, or just a defensive portfolio, right? Because those are designed to do well even if there's a slowdown in the economy, and they're boring usually. So back to your questions. How are we doing for time? We've got 7 minutes, and we've got one more super chat. Okay. The Sub-Zero 77, I hope I pronounced that correctly. Thank you for your super chat. They say, what do you think about Samsung? Okay. So let's take a look at Samsung. Here we go. So here is its description on Stockopedia, which is like a single stock database, if you like. But also it has a nice way of analysing the fundamentals of a company. And it has 3 different rankings: quality, value, and momentum. So you can see that on a quality ranking, Samsung does actually very well. It's got a score of 94. For value, not so good, 33, which means that people have overpaid for it. And if you look at the performance of Samsung, you can see that over the last year or so, the price has gone down from about 1,400 to about 927. So a fair old sell-off for Samsung Electronics. Momentum also not looking great. So this is really the turnaround story. Is the earnings improving? Is the price improving? Neither of those is true. So it scores very low on momentum, low on value. It's still expensive relative to its profits and its cash flows, and the quality is high. So would I be very keen on this as an investment? Probably not, given that combination. If there was a combination of momentum turning the corner and value and high quality, yeah, then I'd be interested. But this stock doesn't score well on that criterion. Quality, so if you look at return on capital, 7.8%, it's not incredibly high. return on equity 9, margin 10, 11%, something like that. Yeah, I'm not hugely, just looking at it quickly, it's difficult to see why I'd see a big turnaround here. Normalised earnings per share looks quite volatile, has bumped up in 2024. Yeah, so I find it difficult to see value there. But still, I don't think I'd probably go for that. Certainly not the criteria I'd look for. I have got a small cap value quality momentum portfolio in the UK, which is just atrociously performing. It's doing incredibly badly. UK small caps are just being crushed, and I just keep seeing it go down. It's very depressing, despite the fact that it actually is stocks which filter very well on these criteria. But it's just an unloved part of the global equity market, unfortunately. So that's not doing well. But Samsung, probably not. So how are we doing? 4 minutes. One more question, and then we're done. What have we got? Okay, so Sharanjit Man says, transferred work pensions into a new SIP as cash about 2 weeks ago. Was thinking to buy global HSBC accumulating ETF. There's a very cheap one, which has got a fee of 0.12%. Would you wait to invest or start drip feeding, investing for about 10 years? Yeah, I think I'd probably drip feed in this environment. In fact, I've got a video going out where I say just that. That should be going out this Saturday. But why is that? Well, I think it's because of the economic uncertainty that we've got right now. I think there's so much weird coming out of the United States right now that markets cannot absorb it quickly enough. Maybe some of these tariffs will be good in the long run, certainly for the US, but I doubt it. And I think a lot of people are now seeing that this is very damaging to the economy. Remember that when Trump took office, the US economy was in very good shape. It had very strong growth, above its trend growth. Inflation was falling, things were pretty good. But now what we're looking at is forward-looking indicators starting to weaken, and huge uncertainty for US companies having to navigate these very uncertain times with tariffs and their input costs, which effectively is what tariffs control. So I think, that's the worry. That's the worry, that we're going to see this uncertainty weigh on profits, weigh on risk appetite, and we're going to see a big pullback in markets. Plus, if you look at positioning, the US is so concentrated and so expensive. It is priced for perfection. And what we're seeing today is not perfection. It's a very worrying backdrop. So we'll just have to see what happens with the tariffs, whether they actually get implemented, whether they stay in place, whether they are very widespread. But it's looking very likely that that's going to be the case. And that's going to be a difficult environment. So yeah, I'd say I'd probably drip feed in this environment because I'm worried about what's going on. I certainly would. We do have one more super chat actually. Rajaseelan Ganaswaran, regular viewer. I've managed to pronounce your name at last. Thank you. Super chat. Opinion on JGGI ETF. Yeah, I love these actually. Let's pull it up. JGGI. Oh. JGGI. No. I think it's one of the JP Morgan enhanced funds. So I'll talk about this in a second. I'll just double check that that's what it is. Yeah. Let me share this with you. So the idea behind these funds is, if it is one of them, yeah, let's see what the definition is of the fund. Here we go. I've just put my head in front of that, I'm sorry. There we go. So JP Morgan Global Growth and Income is an investment trust company. Its main objective is to gain capital growth from world stock markets. It seeks to manage its risk and invest in a diversified portfolio of companies. High conviction portfolio of typically 50 to 90 stocks, and it adopts a bottom-up stock selection instead of geographical or sector allocation. Uses borrowing to gear the portfolio within a range of 5% cash to 20% geared under normal market conditions. So you've got leverage. It's benchmarked against ACWI, a global index, and it's concentrated. So let's take a look at the fee. 0.425, it's not what I thought it was. 0.425 is the expense ratio. And let's look at the performance, which is actually, from memory, I think it's got a good performance. So let's add MSCI World, just for comparison. So MSCI World is the blue line. JP Morgan Global Growth Income is the black line. Let me just double check that this is an accumulation fund. Oh no, this is an income one. I wonder if I can find the accumulation one, if there is one. No, I can't see it listed there. So you're not comparing like with like, unfortunately. So the reinvested income from MSCI World is maybe what's pushing it above this JP Morgan index fund. But you can see that there's not a huge outperformance if it is the dividends which are making the difference. It's looking like it's underperforming, but that may be because of the accumulation nature of the fund I've compared it with. But, is this going to massively outperform? Given that it's got a concentrated position in 40 to 50 stocks, well, maybe. What's certainly true is that the fee's very high. Now, what I do like are some of these JP Morgan enhanced index funds, where they take research from their trading desk and then they twist the portfolio to go overweight the stocks which their analysts say are going to outperform based on their earnings forecasts. And those do steadily outperform. The fees tend to be quite low, unlike this one. And they have got a fairly good track record of beating their index, which is quite exciting. For someone like me who really likes passive, cheap investing, it is exciting to see these funds generate fairly steady alpha. But the way they do it is by not charging too high a fee, not taking a huge tilt, just a slight tilt based on the analyst forecasts for the stocks. And that's a recipe that seems to work quite well. So I would love to do a video about that. And I certainly got in touch with someone who manages these things at JP Morgan. So I think I might get in touch with them and arrange some kind of video, maybe an interview for the podcast to talk about those funds, because I think it's really interesting. But this one, not so much. This recipe doesn't seem to be working particularly well. So let's draw a line under it there. Thank you all for joining us. Please do like and subscribe. Remember our membership. If you want to join us and learn more about investing, you can do that easily. Just go to PensionCraft.com/membership. If you want a one-to-one with me, like this, but just the two of us, then you can do that. Just go to PensionCraft.com/coaching. And if you want the newsletter, which I showed earlier, PensionCraft.com/newsletter. It's that easy. You just get one a week. It's funny. It's informative. Lots of brilliant puns. So do please sign up for that. So hopefully you'll join us as part of the community. If not, we'll meet again next time we do one of these live streams. Take care, everyone, and good luck with your portfolios.